Hey, welcome back. It's Nolan Mathias from Mortgage 360, and this is part 2 in our 6-part series on first-time homebuyers. Today, we're talking everything pre-approvals, from what you need to do in preparation to what a real pre-approval is to what a pre-approval versus a pre-qualification is, because the fact that those two terms are confused is ridiculous. But before we get into it, do me that favor, hit the subscribe button, hit that notification bell, and please hit that like button for the YouTube algorithm. Okay, so in our first video, in part 1 of our first-time homebuyer series, we talked about how to get a down payment, how to save for a down payment, how to get a down payment gifted for you, how to start a side hustle, all things down payment. But today, we're hitting that next step. We're hitting that step that is all about figuring out how much you actually afford, the pre-approval. And this is going to be an interesting conversation because it's a conversation that for first-time homebuyers is confusing. For normal homebuyers, for people who've bought multiple homes, it's confusing. For realtors, it's confusing, and they do deal with this stuff every single day. It's just a confusing topic. So let's start right out of the gate with talking about pre-approvals versus pre-qualifications. Because you know what, if you go into some brokers, some banks, they'll tell you that you need a pre-qualification, and other brokers and banks will tell you need a pre-approval, and some realtors will tell you need one or the other. And let's just make it really freaking clear right out of the gate. The fact that people distinguish between a pre-approval and a pre-qualification, and the fact that people mix them up and so on and so forth, basically makes these terms exactly the same thing. Pre-approval, pre-qualification, it is an identical thing. What matters is not what you call it. What matters is how far into the process somebody goes and how deep they go into your financial situation in order to determine what you qualify for. So it's not the name, it's the quality that matters. And how do you know the quality of your pre-approval? Well, it's really simple. It's what questions do they ask, and then what documents do they ask for to back up the answers that you gave. So in other words, if you get a pre-approval and someone just says, hey, how much do you make? How much debt do you have? Okay, sure, go out and buy a house up to $650,000. That's not a very good pre-approval. But if a broker or a bank asks you what your income is, then asks you to provide things like job letters and bank statements and notice of assessments and tax returns, and asks you for the actual documentation that would be required to verify what you told them, and then pulls your credit and goes through a complete application process, that is a valid pre-approval or a valid pre-qualification. And there can be a huge difference between what you qualify for if somebody verifies your documents versus doesn't. We often have clients referred to us that have been pre-approved by somebody else that end up with a $600,000 pre-approval when they only actually qualified for $400,000 or $450,000, because when the broker or the bank asked them what their income was, they said, oh, well, I make $80,000 a year. But what the banker or the broker failed to ask is, how is that income comprised? Is part of it bonus? Is part of it overtime? Is it all salary or all hourly? How many hours are you guaranteed? There's all these questions that come along with verifying somebody's income that if you don't actually get a job letter and a pay stub or tax returns or all the things that come along with verifying an income, the pre-approval you're giving them isn't worth the piece of paper that it's written on. So again, quality matters, and quality all comes down to verification, verification, verification. So what can you expect when you go to get a pre-approval? Well, first of all, you're going to start with a mortgage application, because anybody who quotes you interest rates without seeing an actual mortgage application first is just guessing. There's too many components that go along with pricing a mortgage for a broker or a bank to say, hey, this is the interest rate you're going to get. Because there's all sorts of things that can affect your rate. It could be your income. It could be when you're purchasing the property, how far out you are. It could be how much down payment you're providing. It could be what your credit score is. All of these things affect interest rates. So for somebody to quote you an interest rate, or for you to go on a rate website and say, hey, I want to see what it would cost me for a 5-year fix, and have a rate pop up and expect that you're going to get that rate, is absolutely absurd. So the first step will be to fill out that application. And the second step will be to provide the documents that support the application that you filled out. So for most people, that's going to be a job letter and a pay stub. The job letter will state your salary, your time at job, and your position. It'll come from your employer. If your employer is a relatively large company, it'll come from the HR department. If it's a smaller company, it'll probably come from your direct manager. Then you'll need to provide a pay stub, and you'll need to provide 90 days bank statement showing where your down payment is coming from, if it's coming from your savings or your RSP. If it's coming from a gift, all you need to provide typically is a bank statement showing that the money's been deposited into your account, and then a gift letter from the family member who's providing the down payment to you. And by the way, you can do a combination of savings and gift. You don't have to pick one or the other. You just have to provide supporting documentation that supports both if you're getting a combination of a gift and a down payment from savings. From there, your broker or your bank will put together the numbers for you. They'll calculate what your maximum purchase price is, and they'll usually send you a pre-approval letter or a pre-approval email stating what those numbers are. Now, one thing to note is that there's often confusion around who does a pre-approval and who doesn't. So when you get a pre-approval, you're getting a pre-approval from your lender. The lender saying, we're willing to take on this client. Now, if your mortgage is getting insured, insurers don't do pre-approvals. So in other words, CMHC, Genworth, Canada Guarantee, they aren't going to look at your deal until such time as you've actually written an offer on a house. So if your mortgage is going to be insured, your pre-approval is only your bank's willingness to do the approval. It's not CMHC, Genworth, or Canada Guarantees. You have to wait for that until such time as you've got a live deal on a property. Now, when you go to get your pre-approval, your bank is also going to pull your credit at that time. And this is why it's important to start your pre-approval process early. And I mean, when you start thinking about the fact that buying a house is going to be something that's in your future. That could be 2, 3, 4 years before you actually plan to do so. Because when your broker, your bank pulls your credit, if it isn't sufficient or if your income isn't sufficient in order to warrant the purchase price that you're going to look at for a property, then what they can do is they can help you set up a plan to get where you need to go, both income-wise and both from a credit standpoint. Now, if your credit's good and your income's good, what your pre-approval will also have with it is a rate hold. And what the rate hold does is it protects you from rising interest rates. Now, in most cases, your rate hold rate is going to be higher than what the current market rate is. This is because the banks have to hedge the interest rate that they're offering you. In most cases, if you purchase a property and rates are lower than your rate hold rate, the bank or the broker that you dealt with is going to honor the lower rate, whichever it is, the one that they gave you a rate hold for or the current market rate at the time. If you're getting your mortgage to a broker, the broker may very well get you a rate hold at one lender, and then when you go to write an actual offer on a property, if there's better rates elsewhere, they may recommend a different lender at the time that you actually go to get your approval for your mortgage. Now, one other thing to note is that pre-approvals don't typically expire. Yes, the rate holds that come with them, they do expire, typically in about 120 days. So you want to make sure that if you go more than 4 months from the time that you get your pre-approval, that you get your rate hold renewed at 120 days. But a pre-approval itself is typically good as long as interest rates haven't changed, your borrowing power hasn't changed. So in other words, you haven't bought anything else on credit, and that your income has remained relatively the same. If any of those things changed while you're pre-approved and before you purchase a property, then you want to connect with your broker or your bank in order to get your pre-approval updated. By the way, the number one thing that makes pre-approvals go bad is people buying on credit after they've got their pre-approval. So buying a car or buying furniture on credit or getting a new credit card and running up the credit card, those are the things that often affect a pre-approval and make them no longer valid. Once you've got your fully verified pre-approval or pre-qualification, it's time to go shopping for a house. In our next video, we're going to talk about how to select a realtor, and you might be surprised at our rationale for how you go about doing that. But in order to see that video, do me that favor, hit that subscribe button, hit the notification bell if you want to see it immediately, and for this video, do me a favor, hit that like button so more people like you can see this video. Cheers.